Well, welcome to the Remarkable Retail Podcast, Season 3, Episode 6. I'm Mike LeBlanc.
And I'm Steve Dennis.
Steve, great to be back on the microphone. We've got a great episode today focusing on department stores because you work for a department store, I work for a department store, and we brought some experts to talk about, and we had a great wide-ranging conversation. Simeon Siegel from BMO, Bank of Montreal, based out of New York, top retail analyst, and Ethan Chernovsky from Placer AI, and they've got, just such great data on who's going where. I wish they had it in Canada. We're a bit envious, but it's wonderful information to check out. You started your career-ish, department stores from Sears, and they've really changed and morphed. And I guess the center of the discussion, and we'll get to the discussion with our guests in a bit, is really what is a department store? What's its function? What does it do in the modern world?
Yeah.
How is it connected to an ecosystem? So it's a really great discussion, but let's jump right into the news of the past week. And to our listeners now, we're now going weekly. We were doing bi-weekly over the summer. We're now going weekly this is our first post-Labor Day episode. So let's talk about IPOs. Last episode, we were talking about the one IPO, and let's now talk about the Allbirds IPO. What were your thoughts around their documentation?
Well, it's a real rush to get a lot of these e-commerce dominant companies into the public markets. Whether that'll turn out to be a bubble or not, I guess remains to be seen. But Allbirds kind of in the same vein as Warby Parker, not around quite as much, but a brand that's really focused on a narrow set of products, originally launched online only, has been getting into stores just really over the last couple of years. I think they're up to about 20 stores. But just like Warby Parker, business looks smaller than I think a lot of folks thought. It's a couple $100 million US, losing money. I think about a negative 15% operating margin, something like that. Again, like we talked about Warby Parker, doesn't mean they can't build this into a much more successful company. But I think Allbirds a little bit more challenging. It's kind of a niche product. I've got my one pair of Allbirds, which I hardly ever wear. Sample of one, but
so what do you think of them? I've tried them on, but I've never actually bought a pair and worn them. They're light by design,
very light, very comfortable. They've expanded their product line a bit over the last couple of years. So and big part of what they sell is the sustainability of their product. So which is very much on trend. But for them to get the kind of valuation that's been talked about, which I think is north of $2 billion, they've already raised a couple $100 million. Right. They got a lot of work to do to make this more than a niche apparel brand. They're talking about getting into athleisure, which is certainly a hot category, but pretty big leap.
Them and everybody else
doing right, and plenty of competition. They're talking also about opening a couple hundred stores. And that seems also very aggressive to me. If we kind of back into the numbers, it looks like the stores they've got so far are maybe doing $1 million a piece in some really expensive real estate. Interesting brand, very much a niche brand. I think they got a long way to go to really prove themselves to be a successful brand on any scale.
So I also saw in the news stores not dead. Who is it? Ace Hardware opening up like 170 stores, right? And there is what's going on here? They're not dead, Steve?
I mean, no one's more surprised than me that physical retail isn't dead. But yeah, I mean, I used to pay a lot more attention to the hardware and home improvement business because I worked in that business many years ago. And hardware stores, not so much because of the retail apocalypse narrative, but more because of the growth of Home Depot, Lowe's, and a lot of the big box Kingfisher in outside the U.S. And that was really thought to be kind of the death of neighborhood hardware stores. But I guess with the growth of all the home categories and perhaps Home Depot and Lowe's was creating some space for getting a little bit closer to the customer with the neighborhood stores. Yeah, Ace Hardware going to open 170 store openings from digitally native brands, old timers like Ace. Just saw the Coresight research that said that store openings are predicted to be up 60% year over year. So yeah, I guess physical retail not dead.
So I was looking at some results. There's a company in the doghouse, Chewy. Their results, not so great. I mean, what happened to the pandemic puppy? Did that just run out of kibble or something? What's going on?
Well, it's hard to be too disappointed about 27% sales growth. But yeah, here's a company that is essentially online only. So leaning into all the shift to e-commerce and in a category that has just been exploding. So their sales results were pretty good, though apparently a bit disappointing to Wall Street. But here's another company that in kind of a perfect storm really can't turn a profit. If you back out their shareholder compensation bit, they basically broke even. And with a 27% sales increase, they improved their EBITDA margin by 20 basis points, which is pretty poor flow through to the bottom line. So yeah, very interesting, but still a company that gets a lot of attention. It's got a massive valuation. But I think some of these mostly online only companies are at some point going to have to demonstrate that they can actually make a decent amount of money with all the capital they put into the business. But whether this will turn out to be the dot-com bust, or next year maybe the dot-com bust, the return of the dot-com bust, I guess we could say, or not, remains to be seen. But
2.0.
I would really
dot-com bust 2.0.
Yeah, I would really think that with some of the factors that have really created kind of this perfect storm, we'd see better performance.
Well, I guess the good news for Chewy as a category is the pandemic puppy thing is real, and it also basically builds an annuity for 5, 7, 8, 10 years.
Right.
For those kind of like ourselves, we got our dog Ziggy before the pandemic, but if all goes well, he's going to be around a bunch of years, right? So now we're all right. Last thing, and we always seem to talk about Amazon because they're always doing something interesting. But Amazon has joined with Walmart. They're staffing up huge. Now that's not unusual. What did they announce? 50,000. They're going to hire 50,000 people. Yeah. Not unusual given their scale and scope and turnover. Remember, we talked to Brad Stone about how they actually like some turnover, particularly at the frontline warehouse. But when you peel it back, it looked like this wasn't just about frontline in the warehouse staff. What were your thoughts on it?
Walmart's announcements seemed to be much more about staffing up for fulfillment for the holidays, whereas Amazon's announcements seemed to be much more about tech workers, headquarters staff, those sort of people. So hard to get my head around 55,000 SG&A types that aren't in the fulfillment arena. But I think it's just speaks to their growth. It speaks to what appears to be pretty strong consumer demand, and of course just the diversity of things that Amazon's in. Again, because we talk retail most of the time, the thought process is, this is all to support their e-commerce growth, but it's advertising, it's the studio business, it's Amazon Web Services,
AWL, and
So there's a lot. Things. There's a lot there.
Well, it kind of reminded me, and I was re-listening to the great interview we did with Brad, and if anyone's listening hadn't listened to that, because he actually was thinking about in his first book, do I even call them a retailer anymore? Right. And we had that discussion. I mean, who knows? Maybe 25,000 of these folks are going to space and working with Blue Origin. I mean, it's a very broad, who knows, right? I mean, maybe they're starting an outpost on the moon, for goodness sakes. I don't know where they're going to put them all.
So I guess send the returns.
Yeah, I guess. All right. Well, listen, great introduction. We got a great episode coming up all about department stores. Wanted to remind everyone who's listening on the podcast that we have a YouTube channel with some extended content on there. So be sure and check that out. That is usually posted a day or two after our episode, but always be sure and check that out because it's a lot of fun. You get to see Steve and I in our morning discussion here, which is always a pile of fun.
And the great Floyd behind me.
It is a little Spartan. It's true. A little Spartan back there.
Minimalist.
One book, the most important book. Minimalist. There you go. It's minimalist.
As long as I
Mine's maximalist.
Drop my shoulder to get the book in the shot. Oh, yeah. I don't get nasty grants from my publisher. There, yeah.
Without further ado, let's jump right into our interview with Simeon and Ethan.
Well, today we're going to delve into the future of the department store, and we've got two guests to help us make sense of what's going on. Ethan Chernovsky from Placer AI, who is rejoining us. He was on with us last year. And we finally got Simeon Siegel, expert on many things retail, to join us as well. So thanks for joining us. Why don't we start off by having each of you guys just tell us a little bit about yourself and your professional journey. So Ethan, would you mind kicking things off?
Sure. So Ethan Chernovsky, I lead marketing for Placer AI. We're a location data company that kind of, you think, people vote with their feet. We're showing you how people vote across the U.S. every day. I come from a background of high-tech startups and market intelligence data. So I worked for a company called SimilarWeb before getting here. And just kind of have fallen in love with the world of offline retail.
How do you follow that? Look at that. Hey, guys, glad to be here. I feel like the line to get onto this podcast is more exclusive than most meatpacking clubs. So I'm really happy to be here.
We accept NFTs as payment for getting on, just in case people are wondering.
So my name is Simeon Siegel. My goal in life is to live in Ethan's shadow. So this is a special treat to be able to follow. So I'm crossing off many bucket list items by today. So thank you. I'm a retail analyst at a firm called BMO. I've been at several different banks. My goal in life, though, is to watch and chronicle, and whenever I can, maybe advise a little bit on this perpetually evolving world of retail that we all know and love so much. And I think what is fascinating, and what I'm really looking forward to having this conversation with you guys, because I know it's going to go there, is what's beautiful about retail is everyone knows it, which means there's always going to be platitudes, and the best part of platitudes are they're always wrong. So looking forward to kind of jumping into this conversation and seeing where it goes.
All right. Well, there is certainly plenty to talk about. So why don't we just jump in? I'm going to be, I guess, kind of a fundamentalist to start things off, which is when we talk about department stores, what exactly do we mean? Because it seems like it's evolving. So let's just level set in terms of what you each think the definition of a department store is, and then we'll go from there.
So I'll jump in here because Ethan and I disagree on what counts as a department store versus an off-pricer. We've had this argument many times. It's amazing. So hopefully we can go there. I think when I think about a department store, it was the model of a business that owned a location and owned curation. And that was historically the way that I viewed it. And Steve, I know we'll get into the notion of the middle, and I think they, unfortunately, for better or worse, many of them epitomize your middle, which you've so eloquently discussed. But I think that if I were to just take one slight qualification, the way that I think about it is that these were companies whose reason for being was being somewhere and offering a curated assortment of product. And I think what will be very interesting thinking through going forward is which of those two aspects are still relevant and how do you hone them best. But with that, I'll pass the torch to hear Ethan's description, which sometimes ventures into the imaginative.
So I mean, he jokes, but I take that label and I wear it proudly, because I think when we talk about department stores, we have for most people, when we start talking about department stores, we have this very clear image of what we're referring to, and yet that group is not a single homogeneous unit, and instead, I think we have to start classifying it a little differently. So the definition that Simeon gave is great, but putting Macy's and JCPenney in the same category as Target, in theory fit in that same kind of classification, has challenges to it that don't always make sense. And I think there's this element of, are you outdoor oriented? Are you a mall oriented? Are you considered more high end or lower end? All of these elements really play in, and we need to be, I think, as we become more sophisticated in how we define what belongs in which elements of the department store landscape, we're able to have a much more interesting conversation of how we expect it to evolve and how we think it should evolve.
A question I would have, so I would say my historical, not that anybody asked me, but I'll volunteer it anyway. My historical definition of department stores, not to be too cute about it, was that they had departments, right? That the consumer understood that certain stores had not only very structured departments, but they also had pretty wide assortments. They were serving a pretty wide, at least in apparel, pretty wide mix of style points of view and price points, whether you're talking about Penny's or Nordstrom or Macy's. I don't know that whether that definition is historically accurate or is useful. I guess the question is going forward, what really matters. So would you say when you hear that Amazon is talking about a department store, or that neighborhood goods, which some people will be familiar with, is a new kind of department store, are we just getting into semantic arguments, or is that an important distinction as we look at how things are going to move ahead? Ethan, you want to start off on that?
I think it's neighborhood goods is a great example, because neighborhood goods to me feels like Macy's 2.0. And like this, they've taken that concept where I trust the Macy's brand to do the discovery for me, and then therefore that's the big draw. I think they really emphasize that angle in a really exciting and powerful way. So I do see them as kind of the next step forward, whereas I wouldn't put them in the same category as, again, Target or another, Kohl's even.
Mm-hmm.
So let me ask you guys a question. So Steve, if I can ask based on that, would Revolve and would Stitch Fix, would these be department stores too? And I know that sounds like such an obviously dumb question, but I think that if the notion, and this is why I defined, or at least tried to adopt the definition that I started with, where if what departments used to offer you was this curated assortment, you knew you were going to be able to trust the merchant on the other end, and it was location-based, well, then the reality is that's what the benefit of e-com was. Location becomes your living room if you trust the curation, whether it's if you trust the bot that's delivering you an algorithm or whether it's an assortment of other brands. I think that the interesting part is we've seen this kind of race to create the new box. And whether it was Groupon, whether it was an actual box, whether it's just a new form of online service, I think that's where, and it gets to the conversations you've done a lot of work on, you have to make, I'm a huge proponent of stores. But to your point, it's what are those stores offering me? And I think they can no longer simply offer a location and product because other things can do that as well. So I think that's this interesting dynamic that I would throw in as well when thinking about the future of the department store.
I mean, for purposes of this conversation, perhaps we should land on at least a common definition. But I do think that it was a lot easier to understand what department stores meant 30 or 40 years ago because you didn't have all this competition. For the most part, the general apparel, accessory, home merchants were either department stores or discount mass merchants. There wasn't this variety, aside from e-commerce, there just wasn't this variety of off-price and Kohl's and these sorts of players. So I think it was easier to understand historically, and I think in general, people are probably still anchored on that. But maybe for purposes of the conversation, we can maybe talk a little bit more about the kind of historical definition and get into maybe why that's not so useful.
Yeah, I thought the discussion was a great segue into, I spent 7 years in a department store with Hudson's Bay, and they had the unique element of having both a traditional department store, which was the Bay, and if you're in Canada now, it's called Hudson's Bay. They also had a mass merchant, Zellers, which is like a Target, and then they had some specialty stores. So we often talked about what is the role of a department store. And one of the things we haven't talked about really is, aside from location and curation, there's also the one-stop shop element of department stores, which we, would lean on pretty heavily, as in you can get the one place where you can find everything you need. And it felt like there is a bit of a renaissance during the COVID era where, consumer behaviors changed quite dramatically, right? Less trips, bigger baskets, and the cross-sell, upsell religion became something self-fulfilling, like a prophecy that happened. Simeon, as you sit and observe results and think about the department store category, is this a new tailwind behind them that you might think of? Is it a second life?
God, Michael, Renaissance is such a better word than accelerant. I feel like accelerant was the word of COVID. Renaissance is perfect. and so my team did a lot of work around this. We published a report last year titled, Did COVID Actually Save Retail? And it was this fascinating thing that everyone is inclined, the first sign of weakness, you shut your stores. Right, that has been where we've gone. And the notion of retail being overstored across the U.S. has just been played off on that per capita table that everyone has seen over and over again. I think more than the overstored problem across the U.S. has been the oversaturation of discounts. And so I think that, to your point, what the renaissance of retail has allowed us to do, and I'll give you credit every time I say that from now on, which will probably be a lot. Maybe it'll be a chapter in the segue, the sequel to Steve's book, is I think that you now have people that have realized growth at all costs, and growth for the sake of growth's sake is not a good thing. And I think ensuring, whether it's the focus on the customer, the focus on the product, the focus on the experience, whatever the focus is going to be, whatever triggered the reason the first customer walked into a store, I think companies can now revisit that. And one thing that we found that was so interesting in this analysis, we did a price elasticity of demand analysis, and we showed that last year, if companies were willing to commit to raising price 25%, on average, companies could actually give up 40% of their units, 40, crazy amount, and still walk out profitable.
Thin that assortment out, right.
Exactly. And essentially recognize you don't have to be everything to everyone, but you can give your specific customers everything they want. And I think that's your point of being the one-stop shop doesn't mean being the one-stop shop for the world. It means being the one-stop shop for the people that are giving you permission to outfit their lives.
Well, I love your orientation because, we and I often think about it from a consumer lens, and the consumers were like, I don't want to go to a bunch of different places. And I have to think that after this experience, this big circuit breaker of consumer behavior, what has changed? And what doesn't seem to have changed is the gamification of department store pricing, which is still that same game of high-low pricing that seems for many, not all formats, particularly the luxury, seems to work. Ethan, what are you observing about traffic in and out of? Is it back? Was it just a, Simeon, I take this from your line of work. Was it a dead cat bounce? Was it just, people suddenly rushed in and then it's not going to sustain? Like, what's the data telling you?
So I think there's two things, and before kind of I answer the question, I was sitting here just nodding in a silly way as Simeon spoke, because you saw something really fascinating in the last few months where if you look at the brands that are expanding their retail presence, and it's everyone from Nike to, we heard the Allbirds CEO talk about the potential for hundreds of stores. And it's brands that understand the importance of brand. And, to call back neighborhood goods, we had spoken to Matt on one of our webinars. He talked about the brand centered around discovery. So I have to trust neighborhood goods that they can find cool things on an ongoing basis and solve that problem for me. And it created an interesting experience, but one that not everyone is going to love. And that's probably how you're doing it right. So I think that idea that you don't have to be everything for everyone is so unbelievably important as a wider message. In terms of what we're seeing in the data itself, we saw a really strong uptick throughout the holiday season, throughout the back to school season, from mid-July through mid-August, really strong bounce backs in terms of comping the numbers to 2019, which was a strong back to school season in and of itself. The really interesting thing is going to be what happens in the next few weeks. So if you look at the week that began August 23rd, which was a Monday, there was actually a step back, but part of that is because you're comparing to a week in 2019 that had Labor Day in it. So it's a difficult comparison to make. The really interesting thing is going to be, does this recovery kind of sustain through September when you don't have the same mix of pent-up demand, retail reopening, and a reason to buy because we're all going back to school or work?
And government economic stimulus. Let's throw that in the pot, right? I mean, consumers have been getting checks in the mail to go spend. And as I've often said, the U.S. consumer and the Canadian one as well, they're like the Timex watch that keeps ticking. They just keep shopping. It's funny. I want to follow one thread of something you said about the idea of this curation and thinning out assortment. As more and more DTC brands come to the floor, and this is the second time in my career I've been through this in a major way. You all remember the late 90s. I launched HBC.com in the late 90s, early 2000s. It was all about the disintermediation of retailers, right? But does it fob off onto the consumers the discovery? Like, I got to go discover this stuff myself. It used to be I could go to a department store, and this is what we used to think of a department store is, you're going to find new and interesting things walking around our store. You don't have to just go site by site, store by store, walk by walk to go discover them. Is there still a role in that? And that's for you, Ethan. And then Simeon, I got one follow-up question, and then I'll pass the mic back to Steve.
So the answer for me is that the brand around curation and discovery still exists. It just changed. So the fact is, I can discover brands while I'm kind of scrolling through Facebook, and I can discover brands online, and I discover it when I'm playing on social media and looking at my Instagram, which I don't have, but just assuming I did. So a lot of the discovery happens, but that doesn't mean that if there's a brand, if I walk into a Macy's tomorrow and I find something that I hadn't seen before, that I'm not going to be delighted by that experience. So I think it's become more complex and a little bit more sophisticated because of the channels to discovery that I have that are simpler than they were in the late 90s, early 2000s. It doesn't mean that it's any less important for those department stores to make sure they can deliver on that promise when I actually come to the location.
And Simeon, my follow-up question to you is, and I can't have you on the mic without asking you your thoughts on this separation of business operating units that we've seen from Hudson's Bay, right? So I guess the math there is, if we take the physical stores, physical department stores, and we separate that on paper from the digital, that there's more, it's a 1 + 1 = 4 when we go to raise money. Is there any other justification you can see that makes that make sense? And, raising new funds and access to bigger lines of credit's not a terrible justification, but what are your thoughts on that?
So just to be clear, you throw Ethan a question about Instagram, you give me a question about breaking apart financial engineering. I see how it is.
BMO.
No, listen, it's a very fair and important question. I think that, and I look at the clock and say, how long do we have? Because I think it's another podcast in and of itself. I think what's important, and this is, you alluded to it, right? There's financial conversations here. There's market conversations here. I think that there are operating aspects and operating decisions for businesses. And then there's the stock market. And I think that if you look at companies, I didn't mean to, but if you think about some of the companies I mentioned earlier, Revolve, Stitch Fix, you think about who they want to be, if we're going full circle and saying these are the new department store, and they want to be a Nordstrom when they grow up. Maybe they do, maybe they don't. But ultimately, that type of a shared revenue, third party, go-to-market brands, private label, distributed throughout, but telling you what you want, being that for their target customer. And then you look at their market caps and you think about the fact that these businesses drastically earlier on in their revenue bases have larger market caps than the companies that they might arguably be ecstatic to become when they grow up. And you think, what's the mitigating factor? Well, I guess one, they're recently public companies, all things considered. So maybe there's a little bit of that. But at the end of the day, it's that they don't have stores. So it's funny. It's because the four of us, I think, all agree that blanketly closing stores doesn't make sense. Part of that report that my team did, we showed that no company has ever benefited, has ever seen an EBIT profit raise, whether operating profit dollars or operating profit margin, with a mass store closure. It's a defensive move. It shrinks your business. It might be important, but it doesn't grow your business. And yet, the market sometimes, oftentimes, you mentioned the 90s, so up until a certain time, rewards the companies without this perceived baggage, even though it may very well be an asset. So I think that thought process is helping a lot of companies try to decide, hey, if I'm Urban Outfitters and I didn't have these stores, what would my market cap be then? Obviously, that's not the right operating decision for Urban Outfitters, but it's just as you think about looking at the public market, it raises questions.
Hey, listen, I'm a little mindful of our time, and I want to just make sure that we spend a little bit of time, and I am going to force a bit of the definition, but if we think about the moderate department store space, largely mall-based, but we can maybe put Kohl's in there, we have seen, I think not only a little bit from your data, Ethan, Placer's AI's data, but also kind of this narrative that maybe these moderate department stores are on a rebound, and maybe malls are looking more positive. I personally think that's nonsense, so I'll just put that out there, and I can tell you why. But what's your and I'll say the reason I think it's nonsense is some of the things that we've talked about, which is we've seen this contraction of these retailers that have massive store footprints and are trying to be a little bit of everything. The department store sector's lost share for 20 straight years, approximately. And, it's nice to see some return to traffic, certainly, and it's nice to see, maybe the dead cat bounce that Michael referenced. But what is fundamentally changed in Macy's, Kohl's, Penny's, Dillard's ability to acquire and grow customers? So I would say if there isn't anything dramatic that's changed, nothing dramatic is going to be different over the longer term. So come at me. Yes, no, maybe. Caveats.
Totally agree. But Ethan, you go first.
Kind of. I'll say this from...
And try to reference Instagram in your answer if you can.
Oh, please. What's great is I don't have Instagram. I stopped at Facebook. And I say this
blatant lie.
As a deep and happy optimist, I think there are, if you look at Kohl's as an example, and their decision to have the Sephora locations within their stores. I think that is a really smart, intelligent move of how do you kind of take your offering to the next level. And what it shows, to me at least, and then watching the rebound in visits, which I think is more sustainable there than in some other places, it's that most of these brands are not that many good decisions away from a much stronger rebound. Now, that doesn't mean it's going to be easy. And I agree with you completely that kind of shallow shifts are not going to move the needle in the long term. And you're going to see that continued slow struggle. But it also does show that they have such brand recognition. They have such a powerful foundation that if they can make a handful of smart decisions that are exciting to the customer, they can drive a really significant turnaround and push themselves into a much more positive direction.
Such an optimist. So
I'm the angel on your shoulder, Steve. Here comes the devil.
You're the angel on my shoulder too. That's the problem. So, Steve, I totally agree, right? And I think that what we've talked about throughout this podcast has been stimulus-driven desire to spend or capacity to spend, pent-up demand-driven boost to desire to spend. We haven't mentioned the supply chain raising price because retailers simply don't have inventory for the first time in a decade. And you're just in this perfect trifecta. So I think that I started my conversation originally by saying I love platitudes because they're wrong. Retail's alive, retail's dead. Like none of it's ever true. There's always nuance. And the question is whether we choose to look at it. And so I think when we isolate how many brands are seeing a pickup in price, because we're seeing revenues. It's much harder to drill down into units, especially when people are giving both a version of versus 2020 versus 19. What's happening is there's a massive lift in price because people are willing to spend it because they have more money from stimulus and they really want to buy something because they want to get out of their house, right? If we're putting it simply. So the companies that actually affected change, and Michael, you brought up Target earlier. You talked about, so pulling out of Canada. When I talk about a broad scale store closure, I'm talking about just closing stores, anything that seems to be underperforming. That's different than cutting off limbs of a business that aren't working, right? That's different than pruning defensive. One of the best, if not, I don't remember if it was the best stock in the S&P last year, L Brands owns Victoria's Secret, Bath & Body Works. They actually affected change. They came out, they cut their inventory buys by 50% before it was cool to do so, right? Before the supply chain prevented people from getting inventory. They completely refashioned how they were running their UK business by actually putting it essentially into bankruptcy and then figuring it out. They rearranged their Hong Kong, like they Under Armour's another example. These companies came and took drastic multi-$100-million admissions of defeat, but structural changes for the future. Those are the brands, to Steve's point, that made a change. Companies that took advantage of COVID's, I call it the COVID cover, where just if everyone's revenues imploded and everyone's expenses became optional, then the largest companies in the world became startups. So who pivoted? Right? Companies that pivoted and actually did so effectively, I think, are in a much better spot. Companies that are simply benefiting from that trifecta of spend, we're going to walk out next year and all of a sudden that goes away, that subsides, that normalizes. So 100% on your, I guess we're the devil, Steve, over here versus Ethan's angel. But I think for those that took it, there was opportunity, but that doesn't mean everyone is better off.
Let me segue to one of our couple last questions, and let's connect department stores as a format, however we define them, to the shopping mall, because they're intimately connected. Is there a future to shopping malls as we see the future ebb and flow to formats? They typically have been tied to the hip. I mean, they really, think of traditional anchors. Now we're seeing shopping malls. You think of Hudson Yards, for example, expanding into bespoke food courts and putting condos and offices together and trying to rediscover themselves. Is if as go department stores, do as go shopping malls? Simeon, what do you think?
I think one of my mantras in life is don't drink your own Kool-Aid. And by the way, I drink plenty of my own Kool-Aid, so I'm totally guilty of it. I just try to remind myself. The question is, who's building this? Who's telling the story? Like, are there opportunities for gyms to enter spaces they wouldn't have entered before? Are there opportunities for residential to enter? Sure, right? We've seen college campuses find their ways into malls. So I think there is definitely opportunity to fill vacancies. I guess the question is that the optimal solution, or is it filling a vacancy? Mm-hmm. And if the mall did not have, I love the analysis that often gets done around real estate for retailers and the value behind it. And it seems like an existential question, because if you lose enough retailers that want these big boxes, how much is that real estate really worth? And if it becomes a bunch of warehouses, then what does that do? So to me, I think this is the beginning of a very long story, but I think that the people that own the boxes are very incentivized to find a compelling story as to what they can do with them. And that presumably puts them at a lower end of the leverage spectrum. So I think that we will see this constant evolution of the mall. But if a mall didn't have a reason for being because its location and because of all the different components, recreating another form and convincing people they want to live in a mall that they didn't want to shop in might be harder than it seems on paper.
Well, Ethan, and just last question. I'm just looking through your deep dive report you put out, and it looks like things like the median visit time is almost back to where it was a little shy of in January 2019, like in the before time. So it does seem people are heading back to the malls. Again, is this my God, I just want to get back to a normal life for now, but maybe readjust later kind of thing? Or what's your thoughts on that?
So I think it depends on what you look at. There's a very large number of malls in the US. And so what we're looking at in our index is top tier, class A malls. And yeah, those have a really bright future because they are regional hubs for retail and entertainment, and they can make these interesting pivots and adjustments and evolutions. I think what Simeon is totally right about is there are a lot of malls that don't have anything real and tangible to offer. And so when you break the whole space down into groups, you have this kind of upper tier that is likely going to be even more significant moving forward. You have a bottom tier that is likely going to go away and there's no real opportunity for them. And then you have this middle tier where it's, okay, how do you pivot and adjust in a new environment where the retail hubs, those major malls, are attracting a lot of visits and from a very much larger true trade area than they had in the past. And that's where you get these concepts like, okay, does a school work in a mall? But then you also have a Costco in that space. And then I think that middle tier is where it's interesting. That bottom tier is likely going to be challenged to the point that a recovery is unlikely. That top tier, I don't think there's any challenge. I think the middle is where things get interesting.
Yeah, I definitely agree with that. I think for the bottom tier, you want to be in the bulldozer business as opposed to the retail leasing business. But I just want to lean into being the devil and the cynic in the group. It's very on brand for me.
Thank you, Beelzebub, for making that appearance.
Exactly. Well,
the retail bulldozer, though, it's a nice little title.
I know. I got all these new podcast ideas. Creative destruction, creative construction. I mean, we've got so many ideas. So while we only, I think, touched the tip of the iceberg here in terms of all the different aspects of malls and department stores and so forth. So thanks for giving a perspective. Maybe we'll have to have you guys back on to do a deep dive into other categories. I would encourage, and we'll put this in the show notes, but Placer AI has got all sorts of really fascinating traffic, dwell time, et cetera, cross-shop data. I would definitely encourage you to go check that out, regardless of what part of retail you're interested in. And Simeon and his firm have all sorts of great analysis as well to take a look at. So we'll put those links in there as well. Any parting words from Ethan or Simeon about what we should be looking for as we head into the holidays?
I'm really fascinated to see, because my expectation is September, October are not going to be amazing. I think if November and December are strong for retail, we are seeing the full power of brick and mortar, and a lot of this positivity is here to stay.
I think watch the price point, because I think that holiday doing well is going to be more a function of supply chain still being backlogged at this point. I think as soon as the Ever Given product makes our way here, and I'm saying that hyperbolically because I hope it actually is here by now, but the reason as we go further and further away from the initial pent-up demand, the reason the promotions stay low is going to be, in my opinion, is going to be a supply chain conversation rather than a demand. And I think that as soon as that starts slowing, then consumers can start getting some discounts again.
Well, thanks very much. It's been a great conversation, and we look forward to checking in with you guys later in the year. And as much as I'm a cynic and a little bit of Dr. Retail Doom here, I am hoping that we'll be pleasantly surprised by supply chain and consumers' demand going forward. But we shall see.
Amen.
If you like what you heard, please follow us on Apple, Spotify, Amazon Music, or your favorite podcast platforms, so you can catch up with all our great interviews. Subscribe so that just automatically shows up. Tell your friends, and also in new insights, and new episodes will show up every week. So tell your friends, because that will help us share the word, the good wisdom. Now, be sure and check out, and be sure and check us out on our new YouTube channel. Not so new anymore. We got a couple episodes up there, and just look for Remarkable Retail.